Hello and welcome to the Wealth Advice Market Update filmed on the 8th of June 2023. So we start with the usual market news, and when we look at May, US tech stocks continued an AI frenzy led by the likes of Nvidia. That's a company that specialises in making microchips. Their stock has risen by 150% since the start of 2023, and it's one of the handful of companies that have made it to the $1 trillion market capitalisation figure. We've looked through our portfolios to see what exposure you will have to stocks like Nvidia. We've found that in general it's about 1% of the equity in your portfolio will be in Nvidia. The reason why that's not higher is because of diversification, and we have it split across lots of the large companies. In general, US market gains have been mainly driven by a handful of the big tech companies, the usual names of Apple, Microsoft, Amazon, Facebook, Google, Netflix, and Nvidia that I've mentioned there, while the rest of corporate America has faced a slowdown in profits with cost pressures squeezing margins. One positive bit of news in the US is that the regional banking crisis seems to have been dealt with successfully for now, and the Fed can continue to focus on the main issue of inflation. The Bank of England, the US Fed, and the European central banks have all raised interest rates in May. As telegraphed previously, this was not a shock announcement. So far, rate hikes by the central bank seem to have had a marginal effect in slowing down the economy. Developed market economies continue to show tight labour markets where there are many job openings but still low employment. This is one of the things that have kept inflation higher than might have been expected. When we have a deep dive into inflation, UK inflation rose to 8.7% in April. While this is a fall from March's 10.1% figure, it's well above the economist's prediction of 8.2%. Household services such as energy and food prices remain the largest contributor towards inflation. However, it's encouraging that, as you can see on this chart, household service costs have fallen the most over the past month out of any portion of CPI as energy prices continue to fall. It's more worrying that core inflation, which removes volatile energy and food prices, rose by 6.8% in April, an increase from March's 6.2% figure. As core inflation is not falling as the Bank of England might have hoped, they'll have to continue to be aggressive with their interest rate rises to bring down inflation. As it stands, markets are forecasting another 0.25% interest rate rise on the 22nd of June, with rates forecasted now to potentially go as high as 5.5%. The impact of high interest rates have led to fall in UK house prices. As you can see here on this chart, depending on the data, if you look at Nationwide or Halifax, they're pricing in a fall of 1% or 3%. This is really as the cost of living and the soaring mortgage costs start to take their impact on things like property values. It's believed that over 1.4 million households in the UK are facing the prospect of interest rate rises when their fixed rate mortgages end in 2023, and that's according to a report from the Office of National Statistics. Over 50% of those households who are up for renewal will be coming out with deals below 2%. I was recently talking to a friend who's in that position, and he's been offered an interest rate of around 6%. So there's clearly a big impact coming as people are moving away from those fixed deals. Mortgage lending activity has reduced to its lowest level since COVID lockdowns. Higher mortgage costs have led to this less demand in the property market. The average 2-year rate now is around 5.8%, and some lenders have started withdrawing deals, such as TSB withdrawing its 10-year mortgage over the weekend. The US debt ceiling has certainly been a major issue over the last month. So what is the US debt ceiling? The US government spends more than it collects in taxes, so it borrows to make up for this on an annual basis. Borrowing is done by the US Treasury issuing bonds to the market. The US government is seen as one of the most reliable lenders, having never before defaulted on its debt. So to some extent, that's why this debt ceiling is such an important big deal in the press. The debt ceiling is the limit that determines how much the US Treasury Department can borrow to pay for obligations such as Social Security, Medicare, and interest payments to cover the debt. The US hit its debt limit in January 2023, and since then it's used temporary measures to maintain payments. Analysts forecasted that these temporary measures could only be sustained until early June before potentially defaulting on its debt. In 2011, when the Obama administration reached its debt limit, negotiations continued for up to 2 days before hitting the limit, with US stock markets falling by 15% due to this uncertainty. To put this into context, from 1939 to 2018, the US Treasury increased the debt ceiling 98 times, and the current debt ceiling stands at about 31 trillion. Therefore, raising the debt limit isn't a rare occurrence. The US Congress has been stuck in deadlock recently, with Republicans wanting to limit federal spending on programs backed by the Democrats. Republicans tried to use the debt limit to extract larger concessions, such as refusing to raise the minimum wage, expanding government-funded healthcare, for example, or to raise taxes on the wealthy. However, Democrats want to increase the debt limit without any concessions so they can pursue their higher spending plans to win over the public for the forthcoming elections. A deal has now been agreed, which is good news, which suspends the debt limit until 2025, which is after the new election next year. US Congress passed the bill last week, but there seems to have been limited impacts on the markets, presumably because this was always priced in that there would be a deal and the US wouldn't default, in line with its strength and its view of being such an important lender in the market. So, what does that news mean for market performance? In this video, we're going to go through equity markets, bonds and alternatives. We've had some feedback from clients recently that because their portfolio's multi-asset made of these different component parts, they are interested in more than just the equity performance, so we're going to try and focus on that today. Looking at stock market indices since the start of 2023, one of the reoccurring themes that we had with these videos recently is volatility. As you can see from these charts, there is still volatility in the markets. And as you see towards the end, where we've got June there has been an uptick recently. The top performer there is the NASDAQ 100. And as you can see from the right-hand side, that's really been a kick on with those tech companies that we've mentioned earlier in this presentation. There's also interesting things where the FTSE 100, which is the dark blue, that has outperformed over the year, but has then recently lagged behind. So it's about managing those risks and those diversifications over the long term. We've had some clients who've said to us, the FTSE seems to be doing well, but why have you reduced your UK exposure? Our view for the long term is about having the right level of global equity exposure for your level of risk, and then that will drive long-term returns. When we zoom out to see that performance over 1 year, it's definitely a noisy chart, noisy picture. It's hard to probably pick out many trends, and that is, the volatilities that equity produce. Again, we're looking there in terms of, world indices and global performance. You've got the FTSE World Asia Pacific and ex-Japan, which is the red chart there, G, and then you've got the emerging markets, which is that purpley colour, which is H. Again, they finished the year on a negative position, but the more positive news is those other indices have finished or currently are above the line over a 1 year period. When we zoom out further to see the 5 years, we always say returns should be assessed over a longer period, 3 years and 5 years. So you can see here that equities do add value over the long term. And as you zoom out for that long-term period, you can start to look at those track records. The kick at the right-hand side with the likes of the NASDAQ has definitely been pushed by the likes of those technology stocks that we've mentioned earlier. When we move on to look at bond market performance, bonds are debt, so they're the more stable elements of portfolios, or traditionally they're the more stable portfolio element. But when we look at 2023, that's been a period where we've been dominated by interest rate rises. The capital value of bonds don't like interest rates rising, and as you can see here, actually there's not much difference with the volatility that we've seen from equities. The G, for example, which is the index-linked stocks there, that's had a real fall off at times because of those impacts from interest rates. When we zoom out to the 1 year chart, you can see here particularly stands out the post-September impact of Liz Truss's mini budget because of the impact on gilt yields and interest rates as a result of that going forward. That's really impacted bonds, as we've mentioned. Those bonds there, if we look at G, for example, over the last year, that's down 21%. Traditionally, you wouldn't expect a bond to perform like that and to fall to that extent. But because of the long duration of that sort of instrument, it's quite sensitive to changes in interest rates. And that can help explain why, for example, the conventional gilt stocks and the index-linked gilt stocks are showing that loss over the year. When we look at our portfolios and the bond exposure, it's important to manage that and manage the duration risk, which is why we're looking at things more like US government bonds or sterling strategic bonds, so D and A, for example, for looking at those, and then some corporate bond funds, which is that E chart, to hopefully add value and manage that risk within the portfolios. When you zoom out to the 5-year chart, again, you can really see the impact of interest rates on bonds, especially those two with the high durations that I mentioned. In terms of the other ones, you've got a bit more normality, but on that chart, you've got things like COVID sticking out, and then you've got things like the mini budget certainly showing on the chart. When we look at alternatives, essentially, alternatives does what it says on the tin. It's supposed to be an alternative to the equities and an alternative to the bonds. Some examples that we've got here are gold. We've also got property, infrastructure, and commodities. When we look since the start of 2023, there's been a slight increase on the gold price there. Some of our clients often say to us, well, why don't you have more in gold if it becomes a store of asset and a value for people? The main reason why we don't see that as adding more value to portfolios is because gold might be shiny, but it doesn't produce a return, it doesn't give you a dividend, and also there can be costs associated with holding gold and having that exposure. So actually, unlike an equity, unlike a bond, you're not going to get that return over the long term. Infrastructure projects and commodities, we see them as adding value to portfolios at times, but as you can see here, there can be times that the market can not favour, for example, commodities. When we move over to look over 1 year, again, you've got gold is up there slightly above the base rate, which is the blue sort of cash type figure, and then below that, you've got those other property exposure. Another thing that people often say to us is, should I actually just invest in property? Should I go for buy to let? Should I buy a house myself and hold that as a second property to add value over the long term? As you can see with that direct property exposure, it's not always a positive message. And as we mentioned with the market update, demands for properties and things might not be there in the marketplace currently. When we zoom over to 5 years, you can see that, commodities, for example, did really well when those energy prices went up with Russia-Ukraine conflict. So that's factored in with that volatile red chart there. And you've also got, gold that tends to spike when there's bad news and then fall back when markets are more consistent. When we zoom over to the long term for 10 years, again, you can see where market performance is, how that compares to equities. You've got the S&P 500 US indices there and the red MSCI World, which is a global equity index. When we compare that to the likes of property and the strategic bonds, which is E and D there, it's showing why a portfolio shouldn't have exposure to just equities. For example, if your attitude to risk is moderate or balanced, or you're sort of middle of the road, you don't want to have 100% of your portfolios in the stock markets, which are volatile, which is where we come in to blend things like equities and alternatives to manage the risks and returns for yourselves. And finally, some good news. Those regular viewers will have heard Chris talk about the VIX index before. That's the measure of volatility in the market. This index has hit a 3-year low of 13.91, and that shows that there's a bit less volatility in the market. Hopefully we see that message carrying on into next month, and it can be the start of recovery for equities and market confidence. Hopefully this has been an interesting market update by going into those asset classes in a bit more detail. As always, we encourage lots of questions, so if you've got a specific point you would like us to cover, please get in touch or leave a comment below, and I hope you've enjoyed this update. Thank you very much. Bye.